Good morning, everyone, and thank you for joining us today. We'll be going over the AHP Nevada Targeted Fund, and we'll walk you through the application process, including our scoring and eligibility requirements. My name is Samantha, and I'll be one of your presenters this morning. My colleagues Robert and Brandon will also be presenting. This is our schedule for this morning. During this webinar, we will provide an overview of the bank and the Affordable Housing Program's Nevada Targeted Fund. We'll give you some insight into how we score applications and how we review the financials for need for subsidy and feasibility, and we'll end with a Q&A session. You will be able to submit written questions to us at any point during the webinar in the Q&A dialog box, and they will be answered during this session. Please do not use the chat function in Zoom for this. Included in yesterday's email to all webinar registrants were several helpful documents that we will reference throughout today's presentation. You should have a copy of the presentation, the application, and the financial workbooks. If you aren't already familiar with us, you might be wondering, what is the Federal Home Loan Bank of San Francisco? It's one of 11 cooperative lenders in the U.S. created by the U.S. government in the 1930s to ensure liquidity for home mortgage lenders. Our name is misleading. We are not a federal agency. We are a private company, though federally regulated. We don't make home loans, and we aren't a bank that takes deposits. We are a cooperative wholesale bank that is owned by other retail financial institutions located within our District of California, Arizona, and Nevada. We make loans to our member banks that they then use to support housing and economic development, including home mortgages, construction loans, and small business loans. Since 1990, we have given at least 10% of our annual net income to our housing, economic development, and down payment assistance community investment grant programs. The Affordable Housing Program is the largest of these community investment programs. Out of the 10% annual contribution, the bank has awarded over $1.3 billion in AHP subsidies to produce over 152,500 units of affordable housing targeted to low and moderate income households. We're excited that as of last year, we now have a Nevada Targeted Fund in addition to our AHP General Fund, which will help us better ensure that we are able to support affordable housing for Nevadans. In the 2023 Nevada Targeted Fund, the bank awarded $4.9 million. We received 8 applications and 6 received an award, which makes for an approval rate of 75%. All awarded projects were rental projects. Although this webinar is focused on completing the application, we think it is helpful to give a brief overview of the AHP process. The application must be submitted in partnership between a sponsor and member. There is only one competition per year, and the upcoming 2024 application deadline is Tuesday, March 5th at 5 p.m. Pacific Standard Time. Be aware that there is also a critical earlier deadline. Applicants must request a workspace in our secure portal for each project they would like to submit. The deadline for submitting a workspace request is Tuesday, February 27th at 5 p.m. Pacific Standard Time. If you miss this deadline and do not request a workspace by February 27th, you will not be able to apply. The award announcements will be made in late June. Once an award is approved, both the sponsor and member must attend a compliance webinar prior to requesting the disbursement of the funds. Attendance at a compliance webinar is valid for 2 years. Note that the compliance webinar is different than this application webinar, and our next one will be held in April. Once a project has all permanent sources of financing secured, construction is imminent, and the sponsor and member have attended a compliance webinar, the sponsor and member can request disbursement of the AHP funds. Every 6 months until project completion, members and sponsors must complete a project progress report called the semi-annual survey. Awardees must complete construction and draw down and expend the AHP funds within 4 years of award approval. A project must show reasonable progress towards completion to maintain the AHP subsidy. Once construction is complete and the AHP award has been funded, the bank will conduct compliance monitoring, called initial monitoring, to confirm that the project fulfilled the commitments made in its original application. A request for initial monitoring documentation will be sent 6 to 18 months after the project is complete. Upon project completion, the income retention and compliance period for rental projects will be in place for 15 years. during which the project must continue to meet its original scoring and affordability commitments. For owner projects, The retention period is only 5 years, during which the owner must occupy the home as their primary residence. If the owner sells within the 5 years, the subsidy must be repaid and will be prorated based on how long they've been in the home. Please make sure to refer to our policy updates located under the AHP section on our website, as they provide important policy guidance for the AHP process. The AHP is a source of gap financing for rental and owner-occupied projects, and our current maximum award amount for a project is $1.25 million this year. The AHP is very flexible in what you can use it for and can be used to cover acquisition, construction, or rehabilitation costs, including soft costs and developer fee. You do not need to find a member bank to partner with to submit an award, since all our programs run through our members. Since we recently lost some of our larger members, and since this fund is limited to projects in Nevada, we recognize that it might be more difficult to find a member this year. For this upcoming round, we can help put you in touch with a member bank if you are having trouble finding one to partner with on your application. If you need to find a member bank for your project, please reach out to us offline. The AHP award is a grant, as long as the project is affordable for its full retention period, but it's structured in the form of a forgivable loan, secured by the member with a promissory note and deed of trust. The AHP can only be used to assist those households at or below 80% AMI, though there are ways that multifamily units can have a mix of different incomes, which we'll get into later. The program is structured in a way that rental and homeownership projects compete together, meaning that there is no specific set aside for either project type. AHP awarded projects are required to fulfill scoring commitments. If there are project changes after the award is made that affect scoring, a modification must be requested. A project must demonstrate a financing gap and that it will be financially feasible at all phases. If the project receives AHP funding, it must continue to demonstrate a gap at the time of disbursement and at the time of compliance monitoring. Again, a project has 4 years to utilize the AHP funds and complete construction. The bank will review the project status twice a year and follow up directly with projects that do not demonstrate reasonable progress or the ability to finish in 4 years. Projects awarded AHP funding must comply with fair housing and affirmative marketing requirements. Projects that are already complete, as in those with a temporary or final certificate of occupancy or notice of completion at the time of the application deadline, are ineligible to apply for AHP. For projects that already have an existing AHP award through our general fund program and that need additional funds, you can only resubmit an application to request additional funding if you first cancel the original award. There are some changes in our policy regarding multiple AHP applications this year, which we will cover shortly. Here are some basic eligibility requirements. The Nevada Targeted Fund is only for projects in Nevada, so you'll only be competing with other projects in the state, not California and Arizona as in our general fund. Again, projects that are already complete, as in those with a certificate of occupancy or notice of completion at the time of the application deadline, are ineligible to apply. To sponsor a project, an organization must have at least 1 year of relevant experience, have sufficient capacity to undertake the project and compliance responsibilities, play an integral role in bringing the project to fruition by participating in a variety of tasks during planning, development, and operations. For a rental project, you also must have an ownership interest in the project for the full 15-year retention period. If you have experience with services or management of affordable housing, but lack development experience, we will want to see that you have a development partner who does have that experience, or otherwise getting that experience through members of your team. As mentioned before, the maximum subsidy request amount has increased to $1,250,000. We have a few updates about multiple applications for AHP subsidy, and they are as follows. New for this year, a project may apply for and receive AHP awards from both the Federal Home Loan Bank of San Francisco and another FHLB bank, as allowed by the other FHL Bank's policies, provided that the project shows a need for both AHP awards. If only one award is needed, the project must only accept one award. If you are applying to both the Federal Home Loan Bank of San Francisco's AHP and another Federal Home Loan Bank's AHP, you must disclose that information to us in the application so that we can coordinate with the other Federal Home Loan Bank during our respective rounds. We highly recommend that you reach out to us offline prior to the round deadline if you are considering applying to multiple AHPs so that we can better understand your project situation. We have a couple of other multiple application scenarios. If you have an incomplete project that recently received an AHP award from the Federal Home Loan Bank of San Francisco that needs a larger AHP award, you must still first withdraw that existing award and then reapply to us for a higher amount. If you have a completed project with an older existing AHP award that is still within the 15-year retention period from either us or another FHL bank, you must also withdraw any existing awards before applying for a new AHP award. This would apply if perhaps you want to come in for a new AHP award for resyndication on a project that has also had an AHP award when it was originally built. Lastly, concurrent applications to the Nevada Targeted Fund and General Fund must request the same amount of AHP subsidy in each fund. For donated property, we made a few changes and clarifications. First, that a donation transactions must occur within 5 years of the application deadline or start of construction, whichever is earlier, so as to not penalize projects that are already under construction at application. We also adjusted the appraisal guidelines for below fair market value points so that appraisals must be prepared by an appraiser certified in the state where the project is located instead of one having an MAI designation. The last update here is not a change, but something we wanted to clarify as it has been misinterpreted over the years. For projects owned via a long-term lease that are seeking credit for donation at a nominal value, annual lease payments must sum to $1,000 or less total over the course of the 15-year retention period to receive points, not just be less than $1,000 annually. We're excited to share that we have a new 2-point scoring subcategory within nonprofit sponsorship for emerging developers that are minority-owned business enterprises and/or women-owned business enterprises. This addition increases the category value by 2 points for a total of 9 points. We will cover this new subcategory in depth later on in the presentation. For project readiness scoring, we also have a new subcategory that awards 2 points to projects already in construction, as evidenced by a notice to proceed. For housing for homeless households, guidance has been revised to clarify that the 5th definition of homelessness does not apply to most projects. We will review specific definitions of homelessness further into the presentation. Also, this category has been reduced by 1 point for a total of 5 points to help make room for our new subcategories. Similarly, the small rental projects category has been reduced by 1 point for a total of 6 points. And the subsidy per unit scoring category has decreased by 2 points for a total of 5 points. For the benchmarks that are found in our financial worksheets, we have increased the upper limit of the operating cost per unit per year benchmark from $5,400 to $6,000 based on projects submitted last year in the targeted fund in our portfolio of awarded Nevada projects. Now I will pass it off to Robert, who will go over how to complete and submit the application.
Thanks, Samantha. Here are a few things to keep in mind while filling out the application form. The application automatically adjusts based on the characteristics of your project. Progress in filling out the application is tracked at the top of the workbook and in each section. Applicants can easily jump between sections through hyperlinks within the document. Through icons next to each data field, the form will also tell applicants what information is required and if each section is completed correctly. Make sure to read the instructions for each section and understand the scoring category requirements. Don't forget to reference and upload backup documentation if required for a scoring category. Too often, points are not awarded because documentation was not provided. Unfortunately, we cannot contact you during the round to ask for missing documentation. Address all error or warning messages. The application form is intended to help you get the right information in the right data format for us to score your application. Data fields with error messages will not be scored. Make sure that the information is consistent. For example, the targeting in the application should match the targeting in the financial worksheets. Inconsistent information may result in loss of points. Make sure that your application is 100% filled out before you upload your final version. This will be noted by the progress bar at the top of the worksheet. Almost all the questions require an affirmative or negative response, even if the question doesn't apply to your project. Remember that it is best to fill out the application questions sequentially to avoid formula errors. There are maximum character limits for some text boxes on the application. The text boxes should have enough space for the appropriate responses, however. If you have more to write, you can upload separate additional documents. The application provides an estimated score to be used as a reference only. However, just to note, the bank will make the final determination in the awarding of points. The interpretation and implementation of scoring criteria is at the bank's sole discretion. Application documents must be submitted electronically through our secure online portal. To get started, the member and sponsor must complete and submit a request for a project-specific workspace folder on the secure portal for each application by 5 p.m. on Tuesday, February 27th, 2024. If you do not have a workspace, you will not be able to apply. For each application, the member and sponsor can authorize up to 5 employees to submit documents through the secure portal workspace. We will notify the designated member and sponsor representatives via email to complete authentication to get access for each workspace. The portal users will have to click on the link in the email and follow the instructions. Members are strongly encouraged to review all completed application materials and documentation prior to submittal. As you upload your completed application, combine supporting documentation into one PDF file for each folder. While the portal allows you to upload multiple files to one folder, only one file can be accepted into our system. If files are not combined, we may not receive important backup documentation needed to score your project. Keep the application form and financial workbook as Excel files in the appropriate format. Some things to keep in mind when uploading documents. Make sure documents that need signatures have a signature. We do allow for DocuSign signatures as well. Do not rename, move, or delete the folders. This can cause us not to receive your documents, which could jeopardize your project score. Do not restore files from the workspace recycle bin, as this can also cause errors. If you re-upload updated documents to the same folders, it will overwrite the existing one. Do not submit documents without redacting personal identifiable information such as social security numbers, driver's license numbers, or bank account numbers. Do not upload encrypted documents because they cannot be imported into our system. Make sure that everything you upload by Tuesday, March 5th is what you intend to submit. You will not be able to upload anything after the deadline. Note that there is no submit button in the portal. Whatever is uploaded in your workspace on the deadline is your final application package. Lastly, make sure that the secure online portal website is not blocked by your IT department, or have them unblock it so you can access the workspace. Make sure that there is only one PDF per folder. Combine multiple files into one, and only one file can be accepted into our system. So if you upload multiple documents, it is likely they will not all be received, and you may lose points. Remember that we cannot contact you during scoring. Now I'll start going over some of the scoring overview. As we go through the application, this is how the total 100 points for the application are allocated. Most of the categories are straightforward. All categories are self-scorable in the application, so you can use that document to estimate your score. It's impossible to get all 100 points since some questions are only relevant to rental projects while others are only relevant to owner-occupied projects. This keeps the scoring balance and levels the playing field for both types of projects. Points can only be awarded if any required documentation is submitted and clear. So again, we recommend thoroughly reading the instructions in the application itself, or reference guide, and the implementation plan to make sure you get all points the project is qualified to receive. Our first scoring category is targeting. Targeting is worth up to 20 points. It is the largest possible point category for any one category since we are trying to incentivize serving lower income individuals. Rental and owner projects are scored separately and have different threshold requirements as you can see on the slide here. Rental projects can also include market rate units, which would just be considered unrestricted or units above 80% AMI. But you do not have to check how the higher AMI targeting is going to affect your score. For rental, there is a minimum threshold to be eligible for AHP. You must have at least 20% of the units be targeted to 50% AMI households. For owner-occupied projects, these can only serve households at or below 80% AMI. The total non-income and income restricted units must equal the total number of units in the project. Be sure to indicate the number of total managers units as well for rental projects, regardless of whether that unit is income restricted or not. Make sure to enter only whole numbers with no decimal places, or you will get an error. Information in this section must be consistent with the targeting worksheet in financial workbook. And for occupied rental projects, households must be income qualified to meet the AHP targeting commitments at 1 or 2 points in time. Upon initial occupancy after completion of acquisition or rehab for projects with an approved relocation plan or at application for projects without an approved relocation plan. This means that grandfathering in households who were income qualified at a move-in date prior to the AHP application is not allowed. For households whose incomes have increased during their tenure at the project and now exceed the unit's original targeting designation, targeting commitments in the AHP application should reflect current household income. For example, The targeting for a unit where the household was income qualified for a 50% AMI unit at move-in in 2015, who is now earning 80% AMI, should be set at 80% AMI, not 50% AMI. For owner-occupied projects, the scoring is tiered as shown on the slide, but all units must be 80% AMI to be included in the project. There's no way for an owner-occupied home or over 80% AMI households to be funded under our regulation. All approved projects in 2023 received the full 20 points in this category. Donated property is the next category, which awards points to projects that are receiving land for no cost or a steeply discounted value from a third party. Points will be awarded if less than 20% of project units or land associated with the project meets the category criteria. Points can be prorated if only some of the units qualify. There are 3 situations that qualify for points. The first is a straight donation. If the site is acquired or to be acquired from an unrelated third party for $1,000 or less, or a long-term land lease is executed for $1,000 or less in total rent payments over the retention period, then the application is eligible for up to 5 points. Next is acquisition of property from a federal agency. If land is conveyed from a federal agency at a price greater than $1,000, then 1 point will be awarded. The third way to get points is if land was acquired from an unrelated third party at a significant discount to fair market value. So for example, if you have a property with a fair market value of $1 million and your purchase price is $200,000 or 20% of fair market value, you would receive 1 point. If your purchase price is $150,000 or 15% of the fair market value, you'd receive 2 points. If your purchase price is $100,000 or 10% of the fair market value, you'd receive 3 points. And if the purchase price is $50,000 or less, or 5% or less of the fair market value, you would receive 4 points. If this scenario fits your project, fill out the third section under donated property called acquisition of property below fair market value. For all these situations, the donation or conveyance must be an arm's length transaction. In other words, the sale or transfer of a property from a nonprofit developer to its affiliate would not be eligible for points, nor would the sale of property owned by a co-general partner to the partnership be eligible for points. Donations cannot come with any financial conditions or strings attached, such as a loan or other payment conditions. Transfer of title from donor to the sponsor does not have to take place prior to submission of the application to receive credit, but you do need to submit documentation to get points. If the property has not yet been donated, but will be at a future date, the bank will give credit for legally binding, fully executed purchase contracts, lease agreements, and options, or an exclusive right to negotiate that includes specific purchase or lease costs. Note that a letter of intent to donate the property is not binding and therefore would not be eligible for points. As a reminder, points can be deducted in if the transaction doesn't materialize, and a reduction in points could jeopardize your award. So you want to make sure that the donation is a sure thing when requesting points under this category. For acquisition at an amount significantly below fair market value, an appraisal must be submitted with the application and must have been completed by an appraiser certified within Nevada. Also, the appraisal valuation date must be within 6 months of the acquisition agreement date. Information on the support documentation should be consistent with the address and APNs included in your application. Make sure that there is a clear linkage between the parties in the documentation submitted. Also, make sure the donated or conveyed amount is consistently reflected in the development budget. This is the link between scoring and the financial review. We do confirm that there is no acquisition costs or that there are just the nominal costs in the budget. If you have a project where the land was initially donated by a third party, but you will be required to show a value in the budget for accounting purposes, please contact us offline to see if this will be acceptable. We will need to see that there is no gain on sale from any subsequent transfers after the initial donation. For properties that were donated or conveyed at nominal or below market price prior to application, transaction consummation must have occurred within 5 years of the application deadline or start of construction, whichever is earlier. Donation or conveyance at a nominal or below market price must ultimately be documented to maintain points. For projects owned via a long-term lease that are seeking credit for a donation at a nominal value, annual lease payments must sum to a total of $1,000 or less over the course of the retention period to receive points. Under the donated or conveyed property section of the application, you must enter the number of units that apply to each situation. If none of the situations apply, you must enter 0. If you think your project qualifies for these points, see our implementation plan for more details. The average score for approved projects in 2023 was 0.83 points in this category. Now I'm going to pass it to Brandon to take us through the next categories.
Thank you, Robert. So the nonprofit sponsorship category is now worth 7 points. Here, we award points for the involvement of a not-for-profit sponsor in the project and also evaluate their roles and responsibilities to make sure that they are qualified and active in the development. First, the bank has discretion in determining whether a nonprofit sponsor meets the category and general sponsor eligibility threshold requirements. Entities that qualify for points include a nonprofit organization, Native American tribe, a state housing agency, local housing authority, and a state or political subdivision of a state. The nonprofit status of an organization is a threshold criterion, and you would be eligible for the remaining points if the 2 statements under the sponsor classification section are true, and you are a qualifying organization. The general sponsor eligibility requirements are: sponsor has been engaged in the ownership, management, or development of affordable housing for a minimum of 1 year. Sponsor has sufficient capacity and staff experience to perform project roles and integral responsibilities. For rental projects, the sponsor has an ownership interest in the project, including any leasehold, partnership, or controlling interest through the entire 15-year retention period. Sponsor is integrally involved in project responsibilities such as project planning, project development, construction, property management, home buyer counseling, income qualification, and securing development financing or other funding commitments. For not-for-profit organizations or government entities, the project sponsor must be the parent organization and not an affiliate organization. Make sure you are indicating the correct entity in your workspace setup, request, form, and application. Examples of affiliate organizations that do not generally qualify for project sponsorships include the development affiliate of a nonprofit or housing authority, the project LP, a CHOTO affiliated with the parent organization, an LLC affiliated with the parent organization. For rental projects, if the sponsor is one of those entities and meets the threshold criteria for eligibility, then the next 3 points are allocated based on their ownership interest in the project. 3 points are awarded if the nonprofit sponsor entity owns greater than 50% of the project, or the general partner ownership interest when the project is owned by limited partnership, a nonprofit with greater than 20% and less than or equal to 50% ownership interest receives 1.5 points. If the nonprofit has less than or equal to 20% ownership interest, then 0 points are awarded. Be aware that points will not be awarded for commitments that are made contingent on receipt of AHP funding. Only the ownership percentage that is in place as of the AHP application deadline. In the application, you will need to indicate the investor's interest distribution and interest distribution within the GP or managing member for tax credit projects. If there are two GPs or managing members, the nonprofit project sponsor and a nonprofit partner, then 3 points are awarded. Please provide the name and type of entity and ownership interest in the table. If there are two GPs or managing members comprised of the nonprofit sponsor and a for-profit entity and they both have 50% voting and ownership interest, only 1.5 points are awarded based on the nonprofit entity only having greater than 20% ownership interest. Note that 3 points are awarded only if the ownership interest is greater than 50%, not equal to. For owner-occupied projects, up to 3 points are awarded for the previously listed development activities where the sponsor plays an integral role. The next 2 points are awarded based on the percentage of the total available developer fee received by the nonprofit sponsor, including future investor payouts and or cash flow. The bank does not want the nonprofit sponsor stuck with just the deferred fee. If the nonprofit sponsor receives equal to or greater than 20% of the fee, or if by some chance there is no developer fee, then 2 points are awarded. If the nonprofit sponsor receives less than 20% of the total available developer fee, then 0 points are awarded. If a project is in construction at the time of application and there is a limited partnership agreement, operating agreement, or other agreement with the project's investor in place, the ownership interest and developer fee percentage must already be documented by the LPA or by an agreement that is referenced within the LPA to receive points. Otherwise, at disbursement, we will need to see the LPA or operating agreement or a document reference therein confirms the ownership interest and developer fee split. Make sure to select the correct response here. If you mark that the project has no developer fee and we note a developer fee in the budget, you may not receive the 2 points. As proof of tax-exempt status, a nonprofit organization must submit IRS 501c3 letter or a state franchise tax board letter. The bank does not accept bylaws or articles of incorporation as a substitute for showing tax-exempt status. If there is an entity name change, please submit the updated IRS documentation. If the sponsor is a government or tribal entity, then no documents are required. Please also include an organizational chart of the project's ownership structure with your application. All approved projects in 2023 received the full points in this category. A new subcategory has been introduced to the nonprofit sponsorship scoring category that awards 2 points to emerging developers that are minority or women-owned business enterprises. For both rental and owner-occupied projects, if the project earns at least 3.5 points in the preceding subcategories, the project may earn points in this subcategory, meaning the sponsor must have some amount of ownership interest and must receive at least 20% of the developer fee in order to receive these points. Emerging minority or women-owned developer points will be awarded to projects that meet both of the following criteria. 1, the project sponsor is a minority and or women-owned developer defined as meeting at least 2 of the 3 following criteria. The sponsor's CEO or executive director is a minority or a woman. The sponsor's board of directors is greater than 50% composed of minorities or women. The sponsor's senior management, as defined by the organization, is greater than 50% composed of minorities or women. The project sponsor organization has fewer than 5 years of development experience and or has developed fewer than 5 points in the past 10 years. The sponsor must certify that they meet this criteria using the AHP Emerging Minority or Women-Owned Developer Form, which is a new attachment for this year that you will see when you download the application package. As noted, this is a new subcategory. We surveyed other emerging developer programs, and while we believe our requirements are aligned with other programs, please let us know if you discover a conflict between this new subcategory and another emerging developer program. The next category is our first-time home buyer category. Up to 7 points can be awarded to owner-occupied projects that are reserving units for the first-time home buyers. Our definition of a first-time home buyer is listed here, and qualified home buyers must meet one of these criteria. Points are a simple proration based on how many of the total units are reserved for first-time home buyers. At least 20% of the project's units must be reserved for first-time home buyers to qualify for any points here. There were no approved projects in 23 that requested points in this category. The next category is homeless housing. It is now a 5-point category this year where we award points to projects that create transitional housing or reserve and set aside permanent housing units for homeless individuals or households. On the application, please describe the homeless program in the text box provided, including a description of the outreach activities and referral agencies used to reach this population. We have detailed homeless definition in our implementation plan and on the next slide. So if you're planning on applying for points here, please reference that section as we require documentation of homeless status at project completion. We are aligned with HUD's continuum of care, homeless definition, and unfortunately cannot accept at-risk households as a part of the homeless unit reservation. At initial monitoring, we are also required to collect documentation confirming that the homeless status of each individual meets our definition. Be especially careful about making commitments here if you have an occupied building with existing tenants who you think qualify as previously homeless. In addition to making sure they meet the definition at move-in, you will also provide documentation of their homelessness at move-in, which can be hard to locate for long-time residents. So you'll want to make sure this documentation will be available for you before you commit. For this category to be awarded points, the project must reserve at least 20% of the units for homeless households. 2.5 points will be awarded if 20% of the project's units are reserved for homeless households. The remaining 2.5 points are prorated based on a ratio of the remaining units that are reserved for homeless households. When we say reserved, we mean that units should be held vacant unless occupied by a household meeting that definition. Additionally, there is a minimum allowable stay requirement of 6 months. Transitional housing projects are eligible if they allow a minimum of 6 months occupancy and meet the transitional housing definition in the application, which means that, 1, the intention is for households to stay for at least 6 months, not just that they could technically stay, which is true at some shelters. And 2, if the project is operational, most households in the transitional units actually do stay for at least 6 months or move into permanent housing within that time. And 3, households do not need to pack up their belongings and vacate the premises during that day, and they need to have access to supportive services, programs, or other efforts that will help them transition out of homelessness. That means that overnight shelters often do not qualify for homeless points because of the minimum stay requirement and the thresholds needed to qualify as a true transitional housing. Overnight shelter projects can still apply for AHP funds, but will not receive any points under the homeless housing category. If you are developing transitional housing or a shelter project that includes shared rooms, make sure to enter the number of projected households as the number of units in the project. Also, please note that the units listed as reserved here must be consistent with the number of units indicated on the targeting worksheet. On the targeting worksheet, we will look to see if rents are appropriate for the population. Often, we would expect to see a dedicated rental subsidy. If your project is reserving units for homeless households and those units are targeted at greater than 30% of the area median income, and there is no dedicated rental assistance for these households, then you also must explain how the project will be feasible for the 15-year AHP compliance period and provide documentation from a homeless service provider that confirms enough households exist in the target market area that can actually pay the scheduled rent listed for the units reserved for these homeless households. Lastly here, note that the projects cannot score points in both the housing for homeless households and housing for special needs population scoring categories. No approved project in 2023 received points in this category. This slide is the bank's current definition of a homeless individual or household as included in our implementation plan. Make sure that you review this definition carefully if you are requesting points in this category to ensure that all reserved units meet our definition. Note that the fifth definition of homelessness is generally only available for permanent housing developments and not for shelter projects, as it is tied to specific funding sources and does not apply to most projects, as it must be documented with funding guidelines from a government agency that specifically serves this population. Unfortunately, what does not meet the definition are those at risk of homelessness, such as a person living in an overcrowded condition, living in a hotel or motel not paid by charitable funds, or living in the home of another individual due to economic hardship. For all details, please review the scoring category in the implementation plan. So our next category is special needs. Up to 5 points are awarded based on the percentage of units reserved for special needs populations, those that fall into 5 categories listed here. A minimum of 20% of the units must be reserved to get any point, and points will be prorated if not all units apply. For example, if 50% of the units are reserved for one or a combination of these populations, you get 50% of the points. There is no double counting for this category. As you can see from the application, there are multiple categories possible. You will not receive credit for more than one designation for the same unit. More than one of these designations can apply to the same unit, but you will get an error message if the number of units input into the application exceeds the total number of units in the project. Again, you cannot receive points in both this category and homeless housing. So you'll need to make a choice there if you have households that will qualify for both. Also, please note that in the financial workbook, the units set aside for special needs households must be indicated on the targeting and financing sources worksheet. To get points, they must match what is indicated on the application. The average score for approved projects in 2023 was 2.67 points in this category. This is a very simple category where if you have at least 20% of total units with 3 or more bedrooms, you will receive 3 points. For example, if 12 of 45 total project units have 3 or more bedrooms, the calculation would be 12 3 or more bedroom units divided by 45 total project restricted and non-restricted units equals 27% or 3 points. Units must be consistent on both the application and targeting worksheet in the financial workbook. The average score for approved projects in 2023 was 1 point in this category. So rural housing is also a pretty straightforward category. If at least 20% of the units are in a rural area as deemed by a government agency, then you can receive up to 8 points. Points are prorated in this category, so while unlikely, if you have a scattered site project where some units are rural and some are not, you could get partial points for rural units. Rural status can be designated by a state or federal government agency, such as the USDA. The USDA provides this information on their website under Rural Services. You must submit documentation from the designating entity to support your claim. If this information is not provided, the response is considered incomplete and points will not be awarded. The average score for this approved project in 2023 was 2.67 in this category. Now I'm going to pass it back to Samantha for our next category.
Thank you, Brandon. The community stability category is about determining how your project benefits the community at large and contributes to stabilizing the neighborhood. The category is worth up to 17 points. There are 6 main community stability features with specific elements under each feature that you can select. The specific point allocation for each feature can be found in the scoring guidelines in Attachment D of the bank's implementation plan. No partial points will be given, and you must submit required support documentation for each selected element to receive points. Like the rest of the application, even if some of the questions do not apply to the project, you will have to confirm that the question does not apply to the project. So now, let's look at the features a little more closely and we'll go over how the points are allocated. Revitalizing neighborhoods by optimizing project site use. To receive the maximum of 5 points under this feature, your project must involve new construction on an infill site where the lot is undeveloped and already surrounded by existing infrastructure, adaptive reuse of a non-residential building, or substantial rehabilitation of an existing residential building that will prolong the useful life of the property by 15 years. Although it's already stated in the application, under development of an infill site, a recent aerial photo of the site showing the outline of the entire site, as you can see in the slide here, must be provided to receive points. Otherwise, we may have trouble determining the boundaries of the site and could be unable to award points. For a site to be considered infill development, it must be at least 50% undeveloped, and at least 50% of its perimeter must adjoin parcels that are already developed with existing urban uses. Documentation requirements for adaptive reuse of non-residential buildings or structures needs to clearly show the extent to which the project involves adaptive reuse. For substantial rehabilitation points, you need to provide documentation from a third party that shows the work to be performed during the project will extend the building's useful life by at least 15 years. Preservation of existing affordable housing. To stem the loss of existing affordable units, you can receive 2 points if you have an existing project that is at risk of losing its affordability within 4 years through either an expiring rental or affordability agreement, or through the qualified contract process. You must provide documentation to receive points, and the documentation must clearly show when the agreement is expiring or where your project is in the qualified contract process. Proximity to transit and amenities. This feature is worth up to 4 points. For the transit element, a project must be located within a 3rd-mile radius of the specific transit stop. Half point up to a maximum of 2 points will be awarded for each transit service or line with a unique destination. Like the transit component, to receive points under amenities, a project must be located within a 3rd-mile radius of the specific amenities that are appropriate and accessible to the project residents. For example, the project may be located next to an elementary school, but if the population is 100% seniors, no points will be awarded for that amenity. Half point up to a maximum of 2 points will be awarded for each of the 8 amenities listed. Note that you will not receive more than 1/2 point for each of the categories, as shown here in the slide. If there are 3 parks near your development, you will still receive only 1/2 point. Some important things to keep in mind. To receive points under this feature, the transit service or amenity must be in place at the time of application. Also remember that transit agency route maps are required documentation for the transit section. The application outlines how the distances to transit and amenities should be measured and the required documentation. No points will be awarded without documentation or if your documentation is missing information needed to determine distance or destination. Here is a good example of documentation for number of transit lines near the project. This example clearly shows where the project site is, the distance radius surrounding the project, 1/3 of a mile, and the distinct transit lines that are within that area. It also shows a clear scale and legend from a third party. It is very important for both transit and amenities documentation that the third party scale and the legend is included, as we had a number of projects lose points in this area last year because the third party scale was missing. This gives us certainty that the information provided is accurate. Otherwise, we can't tell if it was just created by the applicant. Sustainable developments is worth between 1 and 4 points based on the level of certification achieved by the project. The Nevada Housing Division's Silver State Sustainable Home certifications are included as an accepted certification and will be awarded 1, 2, or 3 points depending on the level of certification. We also will accept LEED, Greenpoint, or Enterprise Community certifications and HERS improvement for rehabs only. You could get 4 points for LEED or Enterprise certified projects with net zero certification. One important point I would like to emphasize is that you should not overcommit here. If the commitment is not met, this would lead to a future project modification involving a loss of points, which could jeopardize the project's award. Also, be aware that new construction projects are not eligible for points related to improvement over an existing HERS rating. Scoring credit for this type of certification is limited to renovations. Economic integration. We also have a 1-point category for when the location of a project is in an upper income census tract per the FFIEC's website. Do not miss out on these points. Even if you are sure your project is in a low income census tract area, go to the FFIEC website and enter the project address to confirm. All project units, including scattered site projects, must be in an upper income census tract to qualify for points. Preventing or minimizing household displacement. 1 point will be awarded for no household displacement for a site that is vacant and unoccupied, or that the project site is occupied and an acceptable relocation plan is in place. To receive the 1 point for no displacement, you must provide a written explanation of the project site history and confirm why no displacement is taking place. To receive the 1 point for displacement with relocation, you must submit a relocation plan. A relocation plan is only required for residential displacement. If a project involves relocation, then we expect to also see the relocation expenses in the budget and an acceptable relocation plan, which we will go into detail about in the next slide. The implementation plan provides specific requirements for a relocation plan. Again, this is only required for residential displacement. If your project is required to go through a relocation plan process by one of its other funders, this should be fairly straightforward, as you can just submit your relocation plan that has been approved by that funder, as noted here. If you do not have a plan approved by federal, state, or local government funders, you can write your own plan, but make sure it meets all the points in this slide, including a budget. This applies to temporary relocation within a building, as well as permanent relocation and relocation where households are moved out of the project for a period of time while work is completed. We recognize that not all elements are necessary for all types of relocation. So if an element is not appropriate, include a brief explanation why it is not necessary for your project's relocation plan. That brings us to the end of community stability, which clearly offers a variety of avenues for your project to receive points. The average score for approved projects in 2023 was 8.25. In the project readiness category, points are awarded to projects that have some measure of site control and have started construction. 5 points are awarded for full site control, where you already own the land or building you are going to develop. Documentation must be submitted as evidence for the different options listed in the application: a final settlement statement, title insurance policy, executed disposition and development agreement, or title report. 2.5 points are awarded for partial site control, where you have an agreement to purchase the land or building. Documentation must be fully executed and valid and is required for all parcels, and it must clearly show that the project sponsor or partners have site control, or that there is a link to the sponsor. Make sure that the addresses and assessor parcel numbers, dates, and signatures are consistent and included in the documentation, especially if this information is in an exhibit. We have a new subcategory for projects that can demonstrate that construction is in progress, by providing documentation like a notice to proceed that has been issued. This subcategory is worth 2 points. In addition to site control, owner-occupied projects can also receive up to 2.5 points for having buyers identified and income qualified, or 2.5 points for a scattered site down payment assistance project. However, this category is capped at 7 points. All approved projects in 2023 received the full points in this category. Native housing. Projects where all units are on tribal land or are developed by or in partnership with a tribal entity will be eligible for points. Points are awarded if the project owner is a tribal government, an agency of a tribal government, a tribally designated housing entity, or an entity created in accordance with tribal law. Alternatively, you can get points if tribal funding is included as a source for the proposed project, such as Indian CDBG, Indian CSBG, Indian Health Services Funds, or NAHASDA funding. The amount of tribal funding included in the sources of funds must be an amount equal to or greater than the lesser of 5% of the project's total development costs, or $100,000. The average score for approved projects in 2023 was 0.83 in this category. Small rental projects. This category is worth 6 points this year and is very straightforward and is calculated automatically in the application. Rental projects with 25 units or fewer receive 6 points. Other types of projects do not receive points. The average score for approved projects in 2023 was 1.17 points in this category. Subsidy per unit. The subsidy per unit category is worth up to 5 points, prorated by taking the amount of subsidy requested divided by the number of units restricted to households earning at or below 80% of AMI. Remember, the maximum project subsidy is now $1.25 million. The scoring for rental and owner projects is different. For rental projects, the range is between $20,000 and $40,000 per unit, with a full 5 points for $20,000 per unit and 0 points for $40,000 or more per unit. For owner projects, the range is between $25,000 and $45,000 per unit, with a full 5 points for $25,000 per unit and 0 points for $45,000 or more per unit. The category is scored when you enter the amount of subsidy requested in the beginning of the application and complete the targeting scoring section. We often get the question, how much should I request? And we encourage applicants to request what the project truly needs to fill the gap. However, you may need to balance what your project needs with what score will make your project most competitive. The average score for approved projects in 2023 was 5.79 in this category. Okay, now that concludes the review of all scoring categories. Next, I'll pass it over to Robert to continue with the next part of the webinar.
Thank you, Samantha. At the bottom of the application form is a scoring summary that will generate as you fill out the application. This tool will help you see your estimated score before you submit the application and should help make sure this process is as accurate as possible. There is no way to predict what the range of scores will be in any given year, but you might want to spend your time on submitting an application if you are estimating only a few points. So now we'll go through the need for subsidy and project feasibility part of the webinar. But before we do that, we're going to take a 5-minute break. So we will continue the webinar in 5 minutes. Okay, welcome back. We are going to get into the next part of the webinar. We will provide information on how we evaluate a project's need for subsidy and feasibility and go over the financial worksheets. Not only do applications have to score well, but They must also meet the Federal Home Loan Bank standards to demonstrate that the amount of subsidy requested is truly needed and that the project is financially feasible. In determining need for subsidy, we look to see the project's sources of funding, including the AHP, equals the projected development costs, and we look to see that AHP is filling a project's financing need that's not covered by other funding sources, and that the project is only asking for enough AHP to truly fill the gap. If there are more sources than uses, then some of the AHP funds requested are not needed and it becomes a need for subsidy issue. If there are more uses than sources, then the project is still short funding and is not considered feasible. Note that you need to have all sources committed, but we do not need to see the budget is balanced. And for rental projects, we review the 15-year operating pro forma to make sure the project has positive cash flow throughout the 15-year compliance period, or that there is a sustainable source of capitalized reserves for projected deficits. We also look to make sure that there is not too much cash flow, which would indicate the project could take on a conventional loan instead of using AHP funds. For financial benchmarks, these help us evaluate need for subsidy and feasibility. We use a set of financial benchmarks that projects must meet, such as operating cost per unit, construction cost per unit, and management fees charged per unit. If your project deviates from a benchmark, an explanation must be provided, and we often require third-party documentation. And please be aware of the note at the bottom of the slide. A project must demonstrate need for subsidy and financial feasibility at application, disbursement, and compliance monitoring. If your project has cost savings or receives additional unexpected equity, this could result in required repayment of the AHP subsidy. There are several factors at play here, so please contact us if you think you may have a need for subsidy issue after you are awarded funds. These are some key points we keep in mind when we look at the application to evaluate the need for the AHP subsidy and the financial feasibility of the project. If there are more sources than uses, then some of the AHP funds requested are not needed and it becomes a need for subsidy issue. If there are more uses and sources, then the project is still short funding and is not considered feasible. To be financially feasible, a rentals project's operating pro forma must show that it has sufficient projected cash flow to cover its projected annual operating expenses and debt service. If there are operating shortfalls projected in the rental project pro forma, there should be operating subsidies or operating reserves to ensure that the project is operationally feasible. Please provide evidence of those subsidies if these are secured already. We also check that the financials match the story being told in the application's narrative. The expenses indicated in the development budget must be consistent with the project's description and scoring sections. For example, under the community stability scoring section, if the project claimed scoring points for mitigating the displacement of previous residents during construction with a relocation plan and compensation, then we expect to see relocation costs in the development budget. Lastly, we check if the project has any benchmark deviations, which I'll go into more detail in the next slide. If there are benchmark deviations, we need an explanation for why the project's costs are outside what we'd normally see. All deviations will be calculated automatically in the workbook, and highlighted in yellow, except for interest rates, which need to be compared to the rates in the reference guide. Benchmark deviation explanations must be quantifiable in relation to the amount that exceeds the benchmark. For example, if your project exceeds the operating cost per unit benchmark by $50,000, you will explain that $40,000 of payroll is for 24-hour desk clerks and $20,000 of extraordinary maintenance and repair costs that are not typical requirements but needed to serve the project's homeless population. Once that $60,000 is removed, the project is within the benchmark. If the project has conventional debt and the debt service coverage ratio benchmark of 1.45 is exceeded in year one, it indicates that the project might be able to take on more debt, that the project may not demonstrate a need for the entire AHP amount requested. In that case, it may be ineligible unless there is a legitimate reason the project cannot take on more debt. Note that we have a line in the pro forma for required services. As you know, we are required to show services below the line, so it is not an operating expense. However, there is a test debt service coverage ratio, so that is easier to see how other funders are looking at the project's debt service. Our benchmark still ties to operating expenses without services, but we hope that the test DSCR will make it easier to explain some of these deviations. For the construction cost per square foot benchmark deviation, site work can be used as part of your benchmark deviation explanation now. Environmental remediation and hard cost contingency are still not included in the cost per square foot calculation and should not be considered for an explanation. Our financial worksheets are intended to accommodate the wide variety of projects that apply for AHP. So here are some key points to keep in mind for certain types of projects that don't fit neatly into the AHP framework. First, for transitional housing or shelter projects on the targeting worksheet, make sure to list each household as a unit rather than the number of rooms or beds. Make sure to be conservative here for projects with a fluctuating number of households, as many scoring areas are tied to the number of units, and you want to avoid being in the position of losing points and potentially the award. In the future, if your occupancy turns out to be lower than expected. Often the feasibility of these projects is based on donations, capital campaign fundraising, and another business revenue. We want these types of projects to demonstrate that they have a reliable history of raising the funds they need for development and have a reliable source of income to cover operational expenses. We consider 3 years to be reliable, so please upload 3 years of audited financial statements to the evidence of committed financing folder if this applies to your project. Mixed use projects. Under AHP regulations, residential rents cannot support the commercial portion of the property, but commercial rents can cover residential expenses. Note that even though commercial income can cover residential expenses, the residential portion of the project should not be dependent on commercial income for feasibility. If you have a mixed use project and the commercial space will be revenue generating, fill out the 15-year commercial operating pro forma in the workbook. Make sure to answer the 2 questions at the top of the worksheet On the development budget, there is also a line at the bottom of the worksheet that indicates the development costs for the commercial space. Make sure that line is filled out if your project is not on a triple net lease and commercial and residential expenses are together. So a couple things to mention on the financial workbook. Please use the version that comes with the application packet you download. Rental projects have their own specific Nevada Targeted Fund workbook. You should see version 1.1 at the top. For owner-occupied projects, you will use the same workbook as the general fund, which is version 5.4. Essential instructions and notes on completing the financials are included in the workbook on the first tab. We strongly recommend reading the instructions on the first tab to completing the workbook. Workbooks should be filled out sequentially, starting on the second tab of the workbook with the targeting worksheet. The worksheets are all connected and the figures and amounts are automatically pulled into other sections of the workbook. We have password protected the shaded cells so that they can't be altered. You can only enter data into unshaded cells. Again, review the worksheets so that they are accurate and consistent before submitting them. Please make sure that the sources in the workbook match the source documentation provided. Note that we rarely allow changes to the workbook after it has been submitted. Okay, now we will review the actual financial worksheets starting with rental projects. I'm going to pass it off to Brandon, who will take us through the workbook in one moment.
Robert. So we highly recommend that on the instructions and note worksheet that you review this worksheet while you complete your workbook. It contains a lot of helpful instructions and policy guidelines. For the targeting worksheet, input the AMI levels in this worksheet to calculate the target income for each unit type. Make sure appropriate AMI targets are set for the population being served. The worksheet, see the bottom, calculates the rental income from your project and auto-populates the 15-year operating pro forma. At the lower left-hand corner, you will note that 20% of the units must be targeted to 50% AMI or below. Non-restricted units and manager units. Please be aware that if there is a field where you can include non-income restricted special needs units, such as seniors, if appropriate. There is also a similar field for non-income restricted large family units. 1, enter the annual 50% very low AMI, adjusted for family size based on HUD income limit guidelines. If HUD doesn't release the 2024 income limits by the deadline, please use the 2023 limits. Upload a copy of the HUD income limits page showing the appropriate income limit data for this project. If applicable, indicate which units are reserved for homeless or special needs populations. The number of units reserved must be consistent with the homeless or special needs application scoring categories. Please input whichever category the project is seeking points under, either homeless or special needs, not both, due to the scoring guidelines which prevent double dipping in these categories. The AHP application network will compare this front row to the selections made in the application e-form. Again, for transitional housing or shelter housing, enter the number of projected households as the number of units. Transitional housing units must meet the refined early webinar. Do not input operating subsidies as rental subsidies. There is a specific area where you would input the operating subsidy in the 15-year operating pro forma. AHP guidelines require that the rent paid by each household, exclusive of utilities, not exceed 30% of the targeted income for the unit. Indicate the total rent received and the amount of rental subsidy, if applicable. The farthest column to the right shows if the unit passes or fails this 30% rent test. Provide the project's total residential square footage, including hallways, common areas, and structured parking if these costs are included in the new construction or rehab costs. Only commercial areas of the building and commercial structured parking should be excluded from the square footage. Provide tax credit sales price if applicable. If the project will have tax credits, provide either the actual investor letter to substantiate the pricing or other third-party justification for the targeted pricing. Indicate construction type, either new construction or rehab. Also indicate the building type, apartments, condos, single-family homes, or townhomes. Input the project development costs in the use of funds column. Certain non-cash costs are allowed in the use of funds budget to align with LIHTC treatment, including donated land value, accrued soft loan interest, and fee waivers. Documentation of purchase price acquisition costs must be provided and consistent with readiness and donation documentation. We are requesting this documentation upfront. We are looking for final setting statements or HUD ones, executed purchase or purchase option agreements. If in the community stability scoring section you claim demolition, then we would expect to see expenses associated with this line item here, unless your project is a special case where a public entity has undertaken the demolition within the past 5 years per the scoring guidelines discussed earlier in this webinar. If the property owner, lessee, or sponsor acquires the project property from a party affiliated in any way with the property owner, lessee, sponsor, or any other persons or entities involved in this project in a non-arm's length transaction, the bank will consider such acquisitions to be a related party transaction. When evaluating related party transactions, the bank may consider any net cash gain from these transactions as excess sources of funds, unless the gain is 1, contributed to the project as owner equity, 2, provided to the project as a carryback financing, or 3, used to retire existing debt on the property. For rehabilitation of existing affordable housing projects, not involving the transfer of property, any acquisition costs reflected on the sources and uses worksheet will not be included in the total development cost for the purpose of determining the developer fee percentage. Capitalized reserves such as operating, replacement, transitional, social services cannot be paid for by AHP subsidy or by conventional financing. If capitalized, partnership management, asset management, and/or investor service fee reserves are included in the budget, provide an explanation and third-party documentation justifying why the capitalized fees are required. Excessive and/or unnecessary reserves may indicate that the project does not demonstrate a need for AHP subsidy. The bank, at its discretion, will determine whether the reserves are acceptable and appear necessary for project feasibility. Sources of funds. At the top of the worksheet, there are labeled and unlabeled columns for sources of funds. Indicate the name of the funding source. There are a limited number of columns available, and you cannot add other columns. The workaround in case you need more columns is to consolidate similar sources of funds with a breakdown on an attached document. For example, if you have a number of foundation grants, label one column as foundation grants and, on a separate document, provide a list of foundations and how much each foundation is providing. In each source of funds column, enter the dollar amount on the appropriate line of the cost that each source will cover. Be sure to indicate all financing details, hard, soft rates, etc. Hard debt is defined as contractually obligated debt requiring repayment from project operating cash flow. Excluding residual receipts loans, the spreadsheet fully amortizes all debt and must be altered in the last column to properly reflect simple interest or interest-only payments. The worksheet automatically calculates debt service payments. Debt service payments are also auto-populated, in the 15-year performer. To ensure consistent and reasonable rate assumptions, interest rates and spreads should be set in accordance with the interest rate assumptions guidelines included in the reference guide. If your loan is already committed, use the interest rate set by the lender and provide backup documentation. For required debt fees or any programs in which there are mandatory annual payments, you can now either enter it here as debt service if the project has other hard debt, or as an expense line item in the operating pro forma if the project doesn't have any other debt service. Documentation of approved sources of financing must be provided. Please make sure the sources of financing figures reflected on the worksheet match the figures reflected on the committed financing documentation. Discrepancies are a common occurrence and can result in a reduction in the amount of AHP requested. Note the total committed funds field. Please indicate whether the funds have been approved or not. Remember that the project must demonstrate a need for the entire amount of AHP funds requested. So the sources of funds summary worksheet. This worksheet collects required federal housing finance agency data. Please indicate which sources are applicable to the project. This is only relevant to permanent financing. Do not include construction and bridge financing. Include HUD, USDA, and VA financing under other federal housing programs. If a source does not fall clearly within the listed categories, select other. A project must be financially feasible for 15 years. Input income and expense assumptions. 1. All costs except for the management fee replacement reserves, mandatory debt fee payments, and debt service trend upward. All unshaded cells may be edited. 2. Indicate whether the project is receiving project-based rental subsidy in the top right-hand corner. If the project is receiving rental subsidy, indicate whether it has been approved. If approved, include backup documentation in the evidence of rental subsidy folder. 3. As mentioned before, there is a separate line item expense for any mandatory debt fee payments. Additional lines are included for other expenses. Provide details for these other expenses. Please do not use the words miscellaneous or etc. in your explanation. Indicate residual receipt payments on the appropriate line items provided. This is where you would include any partnership management fees or deferred fees paid from cash flow. Please make sure that the amount input into the pro forma matches the figure entered on the sources and uses worksheet. Social services expenses are still only allowed below the line and not as an operating expense. However, this year we have a specific line item for them. If you have required social services expenses, please include those in the resident services line. The project must have sufficient income to cover expenses. If not, it must have operating subsidy or reserve to draw upon. Lastly, please make sure to adjust debt service if loan payments change during the 15-year retention period. Thank you. If your project includes revenue-generating commercial space, you should fill out this worksheet. This worksheet allows us to assess whether the commercial space is financially feasible on its own. If your project has permanent debt and the perm loan has already been underwritten, indicate whether the lender included commercial income into their underwriting by answering the question at the top of the worksheet. Let us know what kind of commercial lease arrangement there is by selecting yes or no next to the triple net lease question at the top of the worksheet. If the commercial space is operating under a triple net lease, the commercial expense will only be reflected in the commercial pro forma. If the commercial space is not a triple net lease arrangement, the commercial operating expenses entered this pro forma will be reflected in the 15-year operating pro forma. Enter all commercial income and vacancy rate. Total effective commercial gross income will automatically populate in the residential 15-year operating pro forma based on what you include in this worksheet. Enter all commercial expenses in the lines provided. If hard debt was used to pay for commercial development costs, include the amount of debt service that the commercial portion of the building will carry. For the workbook comments worksheet, we have added this worksheet to allow notes within the workbook related to the project budget instead of applicants using supplementary materials documentation folder to submit relevant explanations. The base information for the benchmarks worksheet will be auto-populated for you, except that you will need to manually compare your project's permanent debt interest rate with the benchmark for interest rate assumptions in the reference guide. Please provide detailed explanations of and supporting documentation for all benchmark deviations, examples, requirements of other funding sources. Deviation explanations must be quantifiable in relation to the amount the benchmark is exceeded. For example, if your project exceeds the construction cost per square foot benchmark, you might provide a letter from your contractor or architect which explains that the overage consists of $5 per square foot related to special soils work based on the project site, and that $8 of the overage is attributable to prevailing wages premiums on labor costs. If it were not for the $13 per square foot in extraordinary cost, the project would otherwise be within the benchmark. As noted earlier, the construction cost per square foot calculation includes site work. However, environmental remediation and hard cost contingencies are not included. Remember that this means you cannot use environmental remediation or hard cost contingency as part of your explanation for the deviation. For this benchmark, the bank may use its own portfolio and other construction cost data in addition to RS means estimates in determining reasonable costs. Exceptions to the developer fee benchmark will be reviewed on a case-by-case basis. The benchmark is 15% of total residential development costs, without developer fee and capitalized reserves included on this total cost calculation. Projects that exceed the 15% limit will have to provide reasonable explanation and support documentation for any deviation fee benchmark, like any other benchmark deviation. Note that for us to consider a developer fee benchmark deviation acceptable, there must be an equity contribution that offsets overage. We cannot accept deferred developer fee as a sponsor loan or a sponsor loan as a contribution, different than other funders. If the developer fee increases to be above the benchmark at disbursement or initial monitoring, repayment of the overage or a reduction in the AHP subsidy may be required. Partnership management and asset management fees should be shown as residual receipts unless otherwise documented. So targeting self-score worksheet. No additional points are given for units targeted below 50% AMI. To score the projects targeting AMI targets above 50% must be entered. Thank you. This worksheet is intended to help you maintain consistency between data in the application and data in the financial workbooks. When you have finished filling out both documents, click the Run Comparison Now button to identify any inconsistencies. If any errors are noted, fix them and run the comparison again to make sure the issue is resolved. Finally, I'm going to let Samantha take us through the owner-occupied workbook.
Thank you, Brandon. To start, we will look at the instructions and notes worksheet. We highly recommend that you review this worksheet while you complete your workbook. It contains a lot of helpful instructions and policy guidelines. Next, we will look at the targeting and financing sources worksheet. 1. Enter the current 50% or very low AMI levels, adjusted for family size based on the 2024 HUD income limit guidelines, if available. If HUD doesn't release the 2024 income limits by the deadline, use the 2023 limits. 2. Enter the number of proposed units for each AMI target level and configuration. The AMI data on each unit is linked to the targeting self-score worksheet we provide in this financial workbook. If you already have identified home buyers and know their family income, still only input their percent of AMI. The worksheet automatically calculates the family income, and it is okay if it is not exact. 3. Enter number of bedrooms and assumed family size in financing sources such as the amount of AHP per family, any buyer down payments, and first mortgages. 4. If applicable, indicate which units are reserved for homeless or special needs. The number of units reserved must be consistent with the homeless or special needs application scoring categories to receive scoring credit. Select the units for whichever category the project is seeking points under, either homeless or special needs, not both, per the scoring guidelines that prevent double dipping in these categories. 5. Indicate the terms, rates, payment terms, and status of funding commitments for each funding source for home buyer purchases. Documentation of approved sources of financing must be provided. 6. Enter sweat equity hours if applicable. This would be mostly for Habitat or USDA self-help projects. 7. If the sponsor is providing discounted financing, for example, 0% mortgages, indicate yes in the box and complete the discounted financing calculation worksheet. 8. If the project is a self-help project financed by the USDA RD 502 program, indicate yes in the box. 9. Any additional payments for second or third mortgages must be calculated and entered manually under other payments. 10. Enter other applicable items such as taxes and insurance, homeowner dues, etc. Other items to note. To ensure consistent and reasonable rate assumptions, interest rates and spreads should be set in accordance with the interest rate assumptions guidelines, which can be found in the reference manual. Total purchase price figure auto-populates in the development budget to compare with the total development costs. We are looking at what the applicants are selling the homes for and seeing if the housing expenses are reasonable. If there are too many sources, there may be not a need for the AHP, and if there are too few sources, the project may not be feasible. Now, we will look at the sources of funds summary worksheet. This worksheet collects data required by the Federal Housing Finance Agency. Please indicate which sources are applicable to the project. This is only relevant to permanent financing. Exclude construction and bridge financing. Include HUD, USDA, and VA financing under other federal housing programs. If a source does not fall clearly within the listed categories, select Other. Next, we will look at the development budget worksheet. 1. Select the building type, condos, single-family homes, or townhomes. 2. Enter the average square footage per home. 3. Enter the acquisition costs and development costs by line item. Explain any discrepancies or differences between sources and uses of funds in the space at the bottom of the worksheet. 4. There are situations when financing sources are not required to be secured against the property and will not be reflected down the road in the HUD-1 settlement statement. If you have a situation like this where the sources are less than uses on the worksheets, then please explain it in the development budget comment box. If AHP funds will be used as down payment assistance for the purchase of existing homes with no rehabilitation, enter the acquisition prices in the development budget under purchase of existing homes. The targeting worksheet must reflect a reasonable estimate of the sales prices of the homes to be purchased by eligible home buyers. Ensure acquisition cost is consistent with readiness and donation sections of the application and that documentation is provided. List cash items only. Do not include non-cash costs, which are in the budget as both a source and a use, such as volunteer labor, pro bono services, or expenses to be reimbursed. Include site improvements under the on-site and off-site improvements line items and not under land costs. The construction management, sponsor manage and project specific, line items should not include other overhead costs, those that are unrelated to construction. Include other overhead costs in the developer fee line item. Documentation for construction management costs will be required at initial monitoring if the project is approved for an award. Closing costs are those to be paid by the developer, not the home buyer. For self-help projects, if a lot is sold by the sponsor to the home buyer for a sales price that exceeds the cash cost to purchase and develop the lot, the difference between the sales price and the cash cost is considered the developer fee. Feel free to add any comments on any item in the workbook in the comment box at the bottom of this worksheet. Next, we will look at the discounted financing worksheet. If the sponsor is providing discounted financing for homebuyers, then you will need to complete the discounted financing worksheet. For example, Habitat for Humanity sponsored projects that provide 0% mortgages to homebuyers would need to fill out this worksheet. Total adjusted sources of financing must equal total uses. Next, we will look at the Promotion of Empowerment budget worksheet. This worksheet is for AHP General Fund applicants only. Nevada Targeted Fund applications can leave this worksheet blank. Next, we will look at the Benchmarks worksheet. The base information for the Benchmarks worksheet will be auto-populated for you, except that you will need to manually compare your project's information with the benchmarks for interest rate assumptions found in the reference guide. Provide detailed explanations of and supporting documentation for all benchmark deviations, such as requirements of other funding sources. Deviation explanations must be quantifiable in relation to the amount the benchmark is exceeded. If a project's costs exceed the gross residential square footage cost estimates provided by the RS Means Company, a written explanation, complete with supporting third-party documentation, such as an architect or contractor's estimates, is required. Next, we will look at the Targeting Self-Score worksheet. This worksheet is used for informational purposes only, but it will help give you an idea of what your score will be. And finally, we will look at the AHP application comparison worksheet. This worksheet is intended to help you maintain consistency between data in the application and data in the financial workbooks. When you have finished filling out both documents, click the Run Comparison Now button to identify any inconsistencies. If any errors are noted, please fix them and run the comparison again to make sure the issue is resolved. That concludes the need for subsidy and project feasibility review segment of the presentation. Accessing the application. The application package is on our website. The form to register for the secure portal access is also on our website. You can register for an application workspace on the secure portal right now in anticipation of applying. If you have additional questions beyond what is covered here or answered during the Q&A session, please contact one of us and we will be happy to help you get your questions answered. Note that there are 2 sets of contacts, one for setting up your secure portal workspace and 4 contacts for questions about the AHP application scoring and feasibility. Now we will go to the Q&A session.